So, you want to buy a laundromat. Most people think this is the ultimate lazy money business. You buy a room full of washing machines, you bolt them to the floor, and then you go home, while strangers feed them quarters for the rest of your life. Passive income. The Toyota Corolla of entrepreneurship. Except the average existing laundromat in America sells for somewhere between $200,000 and $500,000. And in 2024, a package of just 3 laundromats in Buffalo, New York, was listed for nearly $9.2 million. That's private jet money for washing machines in Buffalo. And here's the part nobody warns you about. Before you plug in a single machine, some cities will charge you a tap fee, thousands of dollars per washer, purely for permission to connect it to the sewer. Not the washer, not the plumbing. Permission. Now, normally, prices like that would signal a risky business. It's the opposite. Laundromats survive at a rate of roughly 95%, one of the safest business models in the country. Which raises the obvious question, if it's this safe and this expensive, where is all that money actually coming from? Because, and this is the industry's real dirty secret, it's not the quarters. The quarters are almost a decoy. By the end of this video, you'll know exactly what you're really buying when you buy a laundromat, why the machines are the cheapest thing in the building, and how much lands in your pocket if you do it right. Money, of course you have. Knowledge is what we're here for. Let's go shopping. Because the price tag on this business is less of a number and more of a spectrum, and where you land on it determines everything. At the bottom of the market, laundromats look almost suspiciously cheap. A scan of BizBuySell listings in June 2024 found laundromats in small markets going for as little as $25,000. 25 grand, less than a pickup truck. There's an industry name for these places, a zombie mat. A poorly maintained, underperforming store that's technically alive but barely, usually selling for somewhere between $35,000 and $200,000. Essentially, as an asset sale, you'll have to retool with new equipment. In plain terms, you're not buying a business, you're buying a room with plumbing and a problem. But here's the strange part. That problem room is exactly how the biggest name in this industry got started. Meet Dave Menz. In 2010, a corporate employee from Cincinnati with no college degree got rejected by 25 banks before buying a failing laundromat off Craigslist for $85,000. It was actively losing money on the day he bought it. He and his wife had saved $35,000 over 4 years and used $20,000 of it as the down payment. Remember him? He's the payoff at the end of this video. The middle of the market is where most sane buyers live. A typical existing laundromat sells for roughly $200,000 to $500,000, and one industry operator puts the realistic all-in range at $200,000 to $750,000. Once you account for the fixes a cheaper store will need. What determines the exact price? A formula, and it's the most important formula in this entire video, so file it away. An existing laundromat is worth roughly 3.5 to 5.5 times its annual net income. More on why that little multiplier is secretly the whole business later. And then the price tag starts getting silly. That same June 2024 BizBuySell search that found the $25,000 store also found a package of 3 laundromats in Buffalo, New York, listed at nearly $9.2 million. Same machines, same soap. $9.2 million. Prefer to build your own instead? Opening a laundromat typically requires $200,000 to $500,000, but up to $1.2 million in certain areas. Now, you might assume the purchase price is the expensive part. It isn't. It's the entry fee to a series of costs nobody puts in the listing. Start with financing. Lenders in this space typically want a down payment of 35% to 55% of the acquisition cost. Anywhere from $70,000 on the low end to over $400,000. Then the machines. Commercial washers and dryers run $1,500 to $5,000 per unit, and most laundromats operate 40 to 100 of them, which means $60,000 to $500,000 in equipment. Want customers to pay by card like it's the 21st century? Card reader systems generally cost between $40,000 and $80,000. 40 grand to accept money. Then come the gatekeepers. Some municipalities charge sewer connection fees, tap fees, that can run thousands of dollars per washer, which on a 50-machine store is a six-figure toll for the privilege of draining water. The utility companies will demand a deposit of 1 to 2 months of an average bill up front, and sometimes they simply keep it until you sell the business. And if you're buying an older store, renovation costs typically run $50,000 to $200,000. One experienced owner's advice on top of all that: keep at least 3 months of operating expenses in the bank, because the seller may have misled you, the boiler may die, or a clogged drain may flood the store and close you for a week. Cheerful. So the obvious question: why would anyone in their right mind wire $500,000 into a room full of speed queens? Because of what you're actually buying. And it's not washing machines. Here's the mental model. A laundromat is a vending machine for utilities. You buy water, gas, and electricity at commercial rates, mark them up, and sell them back to the public one load at a time. And, this is the beautiful part, the customer does all the labor. They sort, they load, they fold. Your machine just sits there collecting the margin. Customers pay per wash and dry cycle, generating an average of $4.50 to $8 per load, and a well-run store nets margins of 25 to 35%. So take one customer, one Tuesday night, one $6 load, roughly $4 to $4.50 of that covers the water, the gas, the rent, the machine slowly wearing out, and about $1.50 to $2 drops straight into your pocket. For doing nothing. The customer paid you and did the work. Multiply that one load across a whole store and across the country. The US has roughly 35,000 laundromats generating around $5 billion a year, and according to the Coin Laundry Association, a single store's gross income ranges from $30,000 to over $1 million annually, with net profits at the high end reaching $350,000 a year. But that's still not the real machine. Time to close the loop from the top of the video: why the quarters are a decoy. Remember the formula. A laundromat sells for 3.5 to 5.5 times its annual net operating income, NOI, which in plain terms is what's left of the revenue after every bill is paid. Now do the math on what that multiple really means. Every single dollar of new annual profit you create doesn't just pay you $1. It adds $4 to $5 to the price of the business itself. Raise wash prices a quarter, add a soap vending machine, vending, detergent sales, and arcade machines alone can add $500 to $2,000 a month. And you haven't just boosted income. You've manufactured asset value out of thin air. A store generating $100,000 in annual net income sells for $200,000 to $500,000. Push that income to $150,000, and you've created up to $250,000 of resale value. A laundromat isn't a laundry business. It's a machine that converts quarters into an appraised, sellable, bankable asset, a bond that happens to smell like fabric softener. And the growth lever is sitting right there. Hybrid stores that add wash and fold service consistently outperform pure self-service stores. And commercial contracts with hotels, gyms, and restaurants raise the revenue ceiling further. Fun fact most people miss: this is also one of the safest asset classes in small business. Laundromats succeed at a rate of about 95%, with average returns on investment of 20 to 35%. 95%. Restaurants dream of those odds. So if the business is this safe and this mechanical, where do people lose? Start with the bleeding you don't see. Water, gas, and electricity are typically the largest ongoing expense at $3,000 to $6,000 a month. Rent adds $2,000 to $6,000. Maintenance and repairs run $500 to $1,500. Supplies, another $500 to $1,000. For many owners, total monthly overhead lands between $10,000 before loan payments or surprise repairs. Call it up to $300,000 a year just to exist. Your store has to wash a lot of socks before sock one earns you anything. Now, the two classic ways buyers destroy themselves. Mistake 1. Buying the seller's story. This is a cash business, and cash businesses have creative accounting. There's no invoice trail on a quarter. One veteran owner's warning to new buyers is blunt. Plan for the scenario where the seller misled you and the store doesn't make what they claimed. Because by the time you find out, you've already wired the money. The defense is grim, unglamorous verification. Sit outside and count customers. Cross-check the water bill against claimed loads. Water doesn't lie. Sellers do. Mistake 2. Ignoring the iron. Commercial laundry equipment lasts 10 to 20 years, and replacing those older machines is a significant financial undertaking, a wall of capital expense that arrives all at once. Buy a store with 15-year-old washers at a bargain price, and you haven't found a deal. You've found the down payment on someone else's deferred problem. This is how zombie mats are born, and they are not rare. It's estimated that 80% of all laundromats in the US are run down and struggling. 4 out of 5. The graveyard is hiding in plain sight. Fluorescent lights still on. But the darkest story in this business isn't about failure. It's about the one thing laundromats are famous for that has nothing to do with laundry. There's a reason the crime is called money laundering. Al Capone is credited by some with inventing the term by literally buying laundromats to funnel his mob profits through. An estimated $1 billion moved through his various fronts. Legend or not, the logic never died. A room where anonymous strangers feed coins into machines all day is the perfect place to explain cash you can't explain. Which brings us to Atlantic City. To the neighborhood, Taja Laundromat was just a laundromat. To its owner, Toye Tudis, it was headquarters. Tudis admitted to buying and distributing 150 to 450 kilograms of cocaine and roughly 26 kilograms of heroin out of the store, then laundering between $1.5 million and $3 million in drug proceeds through his other businesses: a construction company, a real estate firm, a heating and cooling outfit. With the cleaned money, he and his partner bought more than 30 properties. The empire looked, on paper, like a small business success story. In November, he pleaded guilty to drug trafficking conspiracy. Prosecutors noted he could have faced life in prison. In May 2019, he was sentenced to 22 years in federal prison, forfeiting 20 properties, cash, and other assets on the way down. The washing machines, presumably, kept running through all of it. They don't ask questions. That's rather the point. And it's also why, when you buy a laundromat, regulators, banks, and the IRS will look at your pile of unexplained cash with professional suspicion. You've bought the one business where the books are guilty until proven innocent. So, the survival rules, in order of importance. Rule 1. Verify everything with your own eyes before closing. Count the customers, audit the utility bills, trust the water meter over the profit and loss statement. Rule 2. Price the machine's age into your offer. Because a $100,000 discount on 15-year-old equipment is not a discount. Rule 3. Keep 3 months of operating expenses in reserve. Because boilers break and drains flood at the least convenient moment available. Rule 4. Run it clean. The government has seen this movie. Time to pull it all together and answer the actual question. How much money do you make if you do this right? Scenario 1. The zombie mat play. This is the Dave Men's path, so let's use his actual numbers. Buy a failing store for $85,000 with $20,000 down, then spend years fixing what the last owner wouldn't. For the first 5 years, Menz and his wife took almost no money out, reinvesting every dollar. Today, Queen City Laundry is 4 locations generating over $2.3 million in annual revenue at nearly 40% margins. Call it roughly $900,000 a year in profit. And in about 8 years, the couple went from a net worth of around $50,000 to multimillionaires. Entry cost of a used sedan. Exit velocity of a hedge fund analyst. Scenario 2. The turnkey buy. Skip the zombie, pay full price. Take a store producing $100,000 in annual net income and buy it at the middle of the multiple range. Call it $400,000. Your $100,000 a year of net cash flow pays the purchase back in roughly 4 years. And everything after that is margin on a business that survives 95% of the time and returns 20 to 35%. Then remember the multiplier. Every operational improvement you make, cards instead of coins, wash and fold, longer hours, gets paid to you twice, once as income and once as resale value. Scenario 3. The empire. String enough of these together, and you're the seller of that $9.2 million 3-store Buffalo package, offloading stores that can each gross over $1 million a year, with net profits up to $350,000 to the next rich viewer of a video like this one. Your total addressable risk, lint fires and honest bookkeeping. Your product, water, marked up, folded by the customer. Not bad for the one business in America where laundering money is the entire point, and completely legal.